Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, regulatory landscape, and capital markets. This segment is presented by Charles Schwab. I'm your host, Jill Malandrino, and joining us this afternoon, we have Scott Nations, President of Nations Indexes, as well as Mark Sebastian, CEO of Option Pit. We're here to discuss what declining options prices suggest about risk appetite in the market. It's great to see the both of you. As always, Scott, let's take a look at some of those options prices because they were high, in fact, while the S&P was in rally mode. So what does it mean to you that you're starting to see them pull in a bit?
Yeah, Jill, that was really the surprising thing as far as I was concerned. We're in the middle of an everything rally, and unusually, that included option prices and implied volatility. And when the stock market is making all time highs or at all time highs, it's very unusual to see option prices as a measure of fear be higher as well. But only in the last 2 days, today and Friday, have we started to see option prices come down a little bit. If you look at something like Taildex, our measure of the cost of crash protection, that ticker symbol is TDEX. And I know that we have that chart. You can see that it was high and remained high until it finally started to break on Friday. So what does that tell us, Joe? Well, the fact that option prices were high, that there was a fair amount of fear up until last Friday, that was a reason that investors should worry. But now what they're saying is, now what option prices are saying is, you know what? They're still a little bit high, but they're coming down very quickly. So maybe we don't have any problems. Maybe the shutdown's not going to be a problem for the broad economy. And so there's no reason, option prices are saying there's no reason to own protective options because we're going to continue higher, we're going to make new highs, and there's nothing on the horizon that investors should be afraid of.
Which, Scott, is a bit curious to me. And all we've been hearing about are credit concerns that there might be a downturn. I mean, Jamie Dimon was clearly vocal about it last week. We've been in a credit bull market since 2010. So when you start to see mass headlines like that and people starting to chime in, reflecting Dimon's attitude here, it's just curious to me that it changed when we're starting to hear this type of sentiment in the market.
Yeah, I think the interesting thing was that there was a fair amount to worry about. The shutdown is a real problem. Is it going to slow the economy? Almost certainly. It's also going to reduce the amount of data that we get. So it's going to make tougher for traders to make decisions. Everything was headed higher despite all of this. And that, again, included option prices. So we had an everything rally, gold, silver, even Bitcoin today doing well. But the fact that finally option prices are easing, that indicates that traders are not as worried as they were. It's really for investors, it's a great sign.
Yeah. Mark, well, let's get your thoughts on risk appetite here as well. We can, point to the fact that it's been a relatively strong start to earnings season. We're anticipating another rate cut. To Scott's point, Bitcoin is up, so it does suggest there is some risk appetite out there.
Yeah, I mean, for the first time in a while, it did seem like that. What was really curious, as Scott alluded to, was that leading into October 10th, the S&P, the triple Q, they were all reaching all-time highs. Over that same period, the volatility index was rallying. In the last month leading up to the 10th, we saw the VIX go from below 15 to close at 16.5, and that was right before, kind of the October 10th breakdown. What that tells me is a couple of things. Traders are chasing upside, buying calls, and we also have some stock replacement going on where traders are dumping stocks and buying upside calls to continue to participate. Typically, those are a sign that we could see a little bit of a rollover, similar to what we did see Friday the 10th through most of last week, which was all chop. Now today, Monday, we're getting news that, hey, maybe the government shutdown is going to end. And so you see a pretty nice rally across the board. I would also point out that the bond market, we had a nice run in the bond market leading into the Fed rate cut in September. We're starting to see some of that form again. TLT, IEF, the 10-year note, they're all looking bullish. That's going to be pretty supportive of markets as a whole. I think it also screams small caps look very, very interesting here over the next week or two as we head into the federal rate cut, the Fed rate cut on the 28th.
Yeah. I mean, well, Mark, it's widely anticipated that another rate cut is going to follow suit.
Yeah, I mean, it's at this point, it's almost certain markets are priced. It would be an absolute shock if that didn't happen. The one curious thing now today, we're getting a little reprieve, but normally, traders talk in this term of risk on, risk off. Risk on meaning I want to buy Nvidia and Palantir and stocks that are around a lot when the market's bullish. Risk off being I'm buying gold, I'm buying bonds, I'm buying options. Bitcoin is maybe the ultimate risk on asset, and it had a very rough stretch from the 10th all the way through Friday. It is up today. If Bitcoin's going to start to rally, then that's going to be pretty bullish markets as a whole. And again, I think I like the small end of the curve. I like the Russell 2000 coming over the next week or two, if that is going to be the case.
Yeah. Well, Bitcoin is interesting. And I think perhaps its chop that we saw could be idiosyncratic to the asset class itself, right? We saw the run that it had after there was legislation that was enacted, but we're still waiting on a piece of that to get enacted. And if there are changes during the midterms, or if there, is any change in terms of how policy could look for the asset class, you're almost back to where you were for the prior 4 years, where there was no movement happening. So I think it's a little bit more idiosyncratic as it relates to Bitcoin, and perhaps the anticipation that the shutdown might be over, and maybe we get some forward-looking legislation that could take place here. I think that could potentially be a catalyst, because when nothing is happening and you're not moving along with something like the Stable Act, the Genius Act was already passed, that adds an element of uncertainty in there. That's that I think that's what my thesis is. I'm not sure how anyone else thinks about that, but I do think it might be a little bit idiosyncratic to it.
I agree with you. There's also the risk of these crypto trusts that are forming. MSTR strategy being the biggest of them, but there are a lot of these other little ones. Part of what sparked Friday, the 10th, was a absolute blow up in lesser coins, and some of these firms were forced to sell crypto to kind of cover their margin on some of these coins that are long term not going to have any value that they were playing in. But these crypto trusts, if Bitcoin does see more pressure and starts dipping below 100,000 per coin, you're going to start seeing people look at names like Strategy and wondering, hey, is there a potential real problem here? Because when I look out at kind of the total atmosphere of the market, crypto appears to be the one area that could absolutely take down the stock market if some of these major trusts start to blow up.
Yeah. And Scott, that goes back to the comment I had made before, where there could be some credit concerns. And let's just open that up to alternative investments in general, right? And alternative sources of funding and capital and so forth. Not calling for, a major event, but I do think some of these concerns are warranted.
And we saw that last week with regional banks, worries about the stability of regional banks. And earlier in the month, we saw that in concerns, very legitimate concerns, when it comes to the safety of private credit. Jill, I was fortunate to write a book about stock market crashes. Each one has some sort of financial contraption that spawns a big downdraft in the market. People have been asking me since the book came out, what might be the next catalyst, or rather contraption? What might be the next contraption? Private credit is really scary because it's opaque, it's levered, and it focuses on second and third tier credit names that can't get credit from the regular avenues. And so some of these concerns about both regional banks and private credit could be very scary. Obviously, the market doesn't care right now. Stocks are nothing but to the moon. But if there's another shoe to drop in the private credit space, then I think we really have to be careful.
Yeah, I would agree with you. And perhaps we were continuing to see the momentum in these larger cap names. As an example, if you're a manager and you're below your bench, you're going to have to look towards these, whether you're accessing them through buying the stock itself, or to Mark's point earlier, using an option strategy to get exposure. You're almost going to have to go there relative to small caps, although I understand that falling rates are part of that thesis. But the beta there might be a little bit challenging when you have to make your bench with, we're almost in November at this point. So,
well, you know what they say about what money managers say about a bubble? It's something I get fired for not owning.
Yeah, I mean, it's a good point. And market also, it reminds me of another adage where it's like, escalator up, elevator down. And while the options market might suggest that there is more momentum to go, I want to say it feels different that time. I hate using that adage, but I feel like there are some legitimate structural concerns that we should be mindful of, at least.
Yeah, absolutely. Absolutely. So keep an eye on VIX. We continue, the Qs are now, the Nasdaq 100 is now back at a new all-time high. If we don't see the volatility index and the volatility index on the Nasdaq 100 start to pull back, and I'm talking like sub 15, then some of those concerns are still really weighing on the market. And to Scott's point, you have private credit, some of these mid-cap banks, these crypto trusts. I think somewhere in that cocktail is a recipe for a market spill, if you will.
Right. All right. Well, it's going to do what it's going to do until it doesn't anymore. Appreciate both of your insights. As always, I'm Jill Malandrino, Global Markets Reporter at Nasdaq.